Hello, I'm Romi Savova, the CEO of PensionBee. Welcome to our 2022 results presentation. For those of you who are new to the PensionBee story, we are a leading online pension provider in the UK. We exist to make pensions simple so that everyone can look forward to a happy retirement. We enable our customers to combine their pensions into one new online plan with money managed by the world's largest asset managers. Our aspiration is to build a lifetime relationship with our customers, generating predictable and scalable revenue for our company and for our investors. PensionBee operates in the vast £700 billion market of transferable defined contribution pensions. Over 2022, the market for transferable pensions was resilient, underpinned by automatic enrollment and growing national awareness of the importance of pensions and savings. Against this backdrop, PensionBee continued to position itself as the pension provider of choice, increasing our brand awareness to over 50% and achieving household brand name recognition. We continue to use our data platform to gain actionable insights with respect to our marketing expenditure and thereby reduced our in-period cost per invested customer in the second, third, and fourth quarter of 2022. Ultimately, these achievements will support a long-term decline in the cost of customer acquisition for PensionBee. At the same time, we continue to invest in our secure and scalable technology, releasing innovative new features for our customers, such as easy bank transfer, regular withdrawals, and our impact plan. We look forward to continuing our growth trajectory in 2023, which will see us making headway in achieving our 2% market share target and reaching 1 million invested customers in the medium to long term. We are also delighted to announce an upcoming partnership to offer life insurance products to our customers so they can continue to plan confidently for a happy retirement. 2022 has been characterized by our dedication to serve our customers. We continue to help them prepare for retirement. We help them to combine their pensions, make additional contributions, and use their tax benefits, invest in line with their objectives and values, and make easy withdrawals. As a result, despite the volatile macroeconomic backdrop, we grew our assets under administration to over £3 billion. We welcomed 66,000 new invested customers, resulting in a total invested customer base of 183,000 invested customers. We continue to offer consumers an excellent service, as reflected by our sustained customer retention rate of over 97%. At the same time, our revenue reached £18 million, growing by 38% over the year. PensionBee has been and will continue to be successful, in part because of the enormous need for our services in the £700 billion market of transferable defined contribution pensions, which has grown by more than 60% from 2015 to 2019. There is approximately £1 trillion in defined contribution pension assets in the UK, of which about £700 billion are resting in pensions that are not actively receiving employer contributions. The 25 to 30 million consumers who own these pensions are often burdened by difficult administrative processes to manage them and ultimately to prepare for retirement. Our easy-to-use online pension enables our customers to make the most of their money. We expect the need for PensionBee to continue growing, underpinned by the regulatory commitment to automatic enrollment, regular job switching that generates more dormant pensions, and a growing national consciousness of the importance of pension savings. Indeed, the awareness of pensions as a critical component of personal financial health has grown over the past year, as demonstrated by online search activity for pension-related topics. At the same time, PensionBee data demonstrates that transfers have continued to grow, as the company completed 125,000 pension transfers in 2022, compared to 65,000 transfers just 2 years ago. Similarly, The average pension contribution increased from £507 per invested customer in 2020 to £628 per invested customer in 2022. Conversely, the average withdrawal per withdrawing customer reduced by about 20%, as consumers considered the impact of the cost of living crisis on their discretionary expenditure. Not only have defined contribution pensions remained resilient in 2022, they are set to continue growing in importance. The latest government data indicates that the vast majority of working-age people are expected to have some form of defined contribution pension savings by 2060. At the same time, there is an increasing expectation that mandatory contribution rates into defined contribution workplace pensions will rise this decade. As a result, the underlying trends for PensionBee's core target market have been and continue to be supportive. In recognition of the growing national awareness of retirement savings, we have invested in making the PensionBee brand synonymous with pensions. Having grown our customer base to 183,000 invested customers and having invested £45 million in our marketing activities since inception, we are proud to have achieved household brand name recognition in the UK, as reflected by prompted brand awareness of over 50%. We have been disciplined in our marketing investment, maintaining a cumulative cost per invested customer of £200 to £250 and using our data insights to drive the appropriate return on our marketing expenditure. As a result, and fueled by the growing recognition of the PensionBee brand, we reduced the in-period cost per invested customer in the second, third, and fourth quarters of the year. We expect our growing brand awareness and use of data to continue to enable us to maintain efficiency in our marketing activities and to reduce the cost per invested customer over time. Over 2022, we also continue to invest in our technology. Our technology stack is scalable and secure, built in-house with the purpose of serving our customers. Efficiency and productivity have been and continue to be a key theme as we progress on our medium to long-term objective of onboarding 1 million invested customers. To that end, we focused on automation, further enhancements to our pension transfer journey, and essential self-service features for our customers, such as rapid contributions and intuitive withdrawals. As a result, we increased our ratio of invested customers to staff members, demonstrating operating leverage in our technology. Over 2022, we maintained 99.9% uptime and a response rate of 128 milliseconds on customer-facing systems. Our rapid deployment cycle enabled us to make approximately 1,700 releases in the year. As we continue into 2023, we are focused on delivering against our strategic pillars. We will continue to invest in acquiring customers efficiently. Having achieved household brand name recognition, we are well positioned to continue to reduce our cost per invested customer this year. We will further enhance our brand awareness using efficient channels and use the insights from our data to optimize our performance channels. We remain focused on delivering innovative and useful features for our customers through our product. As a trusted companion to our customers, this year we will deliver them more targeted and engaging content, helping them to grow their pensions with us by keeping them well informed. We will also offer further engaging features with respect to their investments, helping our customers to understand how they can prepare for a happy retirement through savings in the capital markets. Finally, we will soon be introducing a life insurance partnership with LifeSearch, a leading broker for life insurance products in the UK, to help our customers maintain peace of mind while they prepare for later life. This year, we will also continue to invest in our scalable and secure technology. We will continue to make pension transfers more efficient to support our objective of serving 1 million invested customers. We will also expand the use of our data platform across the business, helping our team to make more data-led decisions as we serve our customers. And of course, we will continue to invest in information security through our proprietary Be Secure program, which increases the education and technical sophistication around our cybersecurity activities at the company. While we hope our customers will enjoy their online experience, if they do need support from a human, their personal beekeeper, we will continue to maintain industry-leading response times. We are proud to pick up the phone in under 2 minutes and to respond to live chat in 30 seconds or less. 2022 was also important to us from an investment perspective, having worked with our customers and BlackRock to create a plan that enables our customers to address the world's great social and environmental problems while saving for retirement. We were pleased to launch the Impact Plan in February. Our focus this year will be on embedding the plan into our offering and maintaining value for money across our range of investment products. I will now hand over to Christoph, who will provide a financial overview of 2022 and the outlook and guidance for 2023 and beyond.
Thank you very much, Romi. Hello and a warm welcome to everyone. I'm pleased to cover the financial section of our update. In this finance section, I will start with a brief overview highlighting some important elements of the PensionBee business model and the significant market opportunity. Second, I will cover the long-term compounding nature of our AUA, which is underpinned by strong net flows from new and existing customer and high customer and asset retention rates of around 97%. Third, we will review the profit and loss statement demonstrating the ability of our scalable technology platform to drive operating leverage and achieve profitability on an Adjusted EBITDA basis by year end. Next, we will touch on the balance sheet and a healthy capital position that sees us reaching ongoing profitability without the need for any further primary capital. And lastly, thanks to the vast and structurally growing market opportunity that lies ahead, strong customer acquisition capabilities and our scalable technology platform, we expect PensionBee to further evolve into a high growth, high margin business in the long term. Next, we will turn to look in detail at how our business model works. Our growth strategy is underpinned by the attractiveness of the market opportunity. Our core target markets, the transferable pensions mass market, is vast at approximately £700 billion in pension assets as of 2019. We address that mass market opportunity by solving genuine customer problems. The customer journey often begins with the consolidation of prior pension pots, enabling customers to place the pension savings into one of a simple selection of funds. Our customers' pensions are then invested with our money manager partners, which are amongst the world's largest and most reputable investment institutions. We offer competitively priced solutions at an all-inclusive fee of 50 to 95 basis points. The average realized fee is 63 basis points. We pay a variable percentage fee of between 15 to 20% of that to our money manager partners and keep the remainder on our own accounts. Thanks to the power of our scalable technology platform, we can serve an ever-increasing customer base in an efficient way, which we see in the achievement of operating leverage over time. Technology platform costs are predominantly fixed in nature and capture costs relating to our employees, technology platform subscription, and other corporate expenditure. Lastly, we invest in marketing to drive current and future growth and are pleased to have achieved household brand name status with prompted brand awareness in excess of 50%. Strong brand awareness supports our customer acquisition capabilities, leading to a reduced cost per invested customer over time. In conclusion, we operate in a vast and structurally growing market and serve the need of the mass market of the UK consumers. Our business model sees us generating recurring and predictable revenue, accompanied by our ability to drive operating leverage as we continue to grow. Our high customer retention rates of 97%, coupled with the nature of our customer base, on average mid-career savers in the pension accumulation phase, leads to compounding AUA. As you can see on the left of the page, we show cumulative net flows excluding market growth by customer cohorts. All customer cohorts delivered positive net inflows across 2022, even the early cohorts acquired across 2016 to 2018. This serves as a good reminder of the long duration compounding nature of the AUA and revenue streams. With an average age in the late 30s, our customers continue to demonstrate a long-term commitment to saving with PensionBee, growing the assets with us every single year. On a total AUA basis, the last 12 months have demonstrated the strong resilience of our AUA and continue to grow even despite challenging global capital market conditions. We generated close to £900 million of net inflows over the period. Had markets been stable, this would have resulted in an AUA base of close to £3.5 billion. However, as is the case for all companies across the sector, poor markets have universally impacted AUA. Nevertheless, we closed the year at just over £3 billion of AUA, representing an increase of 17% on 2021. To summarize, generating lifetime value from recurring and compounding asset growth from new and existing customer cohorts is evident in the achievement of both high customer retention rates and continuous net inflows across all cohorts. Next, we take a closer look at how we generate operating leverage on our path to profitability as we serve our customers via our scalable technology platform. A very important milestone in 2022 was the achievement of our Adjusted EBITDA before marketing profitability target in the fourth quarter of 2022, a precursor to the ongoing Adjusted EBITDA profitability milestone expected by the end of this year in line with guidance and expectation. Adjusted EBITDA profitability is in sight owing to the combination of our recurring revenue on the one hand and the scalable technology platform and carefully managed cost base on the other, as outlined as follows. With regards to revenue, thanks to our high customer and asset retention rates of 97% with a mid-career customer base in accumulation phase, as well as a stable realized revenue margin, our revenue is recurring in nature. In fact, despite market volatility in 2022, we grew revenue by 38% year-on-year to reach £18 million. Turning to the cost base, the technology platform costs are a key driver of operating leverage. The technology platform cost bucket increased in 2022 by 27% to £17.8 million owing to investments in product improvements, feature releases, and automation initiatives. Thanks to all of those investments into the technology platform, we are well placed to continue to drive operating leverage for 2023. Another key driver of operating leverage is more efficient marketing investment. We invested £16.6 million in marketing for 2022, which allowed us to increase our brand awareness to over 50% and which corresponded with a reduction of customer acquisition costs over 2022. At the end of the year, the marketing investment placed us into a very strong position for 2023 and will enable us to reduce marketing expenditure this year while growing to keep advantage of the substantial market opportunity ahead of us. In conclusion, thanks to high customer retention rates and associated recurring revenues, combined with our scalable technology platform and cost base, we are looking forward to continuing to drive operating leverage and expect to achieve our next big milestone of full ongoing Adjusted EBITDA profitability by the end of this year. A word on our balance sheet. We have a strong cash and capital position and, as at the end of the year, had £21 million in cash, which will facilitate expenditure this year prior to achieving ongoing Adjusted EBITDA profitability by the end of 2023. With regards to our forward-looking expectation and guidance, we are happy to reiterate the framework shared at the beginning of the year. The market we serve is vast, with around £700 billion of pension assets as of 2019. and continues to structurally grow, as evidenced by greater than 60% growth from 2015 to 2019. We expect it to continue benefiting from the structural shift from defined benefits to defined contribution pensions and growing contribution rates. Over the next 5 to 10 year horizon, we expect to capture a 2% market share of this enormous market, which would translate into serving about 1 million invested customers with an average pension balance of 20 to 25,000 pounds, resulting in revenue opportunity of 150 million pounds in the long term. Given the scalability of our technology platform and our ability to manage the cost base, we expect to achieve a long-term adjusted EBITDA margin of more than 50%. In the short term, we are focused on the achievement of full profitability on an adjusted EBITDA basis by the end of this year. Year-to-date trading has been strong, driven by net flows from new and existing customers, and we expect to continue to execute against our business plan for 2023. I will now hand back to Romi to cover the investment highlights.
Thank you very much, Christoph. As you can see, PensionBee is a leading online pension provider, solving genuine problems for its customers as they prepare for retirement. We operate in the vast £700 billion transferable pension market, serving a broad consumer opportunity. Our household brand name status, the result of years of investment, is enabling us to grow while reducing our cost per invested customer. Our scalable technology platform leaves us well positioned to deliver on our financial ambitions. Our simple long-term business model demonstrates growth and increasing operating leverage as we move into adjusted EBITDA profitability this year. Our committed leadership team is here to serve our customers and our investors. Thank you for your time today. We look forward to engaging with investors.
The average invested customer value is now around 16,000, down from 22,000 the previous year. Partly, obviously, this is some market impact. The comment is that this is viewed as quite low for a pension. How will you grow this over time to your targeted 20 to 25 average, as existing customers don't seem to contribute much on average?
I'm very happy to take this one. And I think that probably combines the first two questions together, which are essentially about pension pot sizes and how we anticipate that they will grow. I suppose the first thing I would say is that from a macroeconomic standpoint, defined contribution pensions are going to be the way that consumers ultimately save for retirement, because of course defined benefit pensions have been and are very much on the way out. And so over the next few years, what we will continue to see is employer contributions being made into consumers' pensions, and of course their own employee contributions will continue to be made as well. Our data indicates that the typical pension can increase by around £3,000 in a year on the back of contributions made by employees and employers. And so from our perspective, we simply need to let time roll on because the pensions that are consolidated with PensionBee are naturally rising as automatic enrollment continues to proceed through society. And certainly the type of behavior that we observe is that our customers will consolidate some of their old pensions, but generally maintain their active workplace pension with their workplace pension provider. But once they switch jobs, which most people inevitably do, as the average person switches jobs around 11 times, those pensions will then be brought onto PensionBee as well. And so we continue to benefit from the contributions that our customers are making in their employers' pensions right now. I hope that answers the question.
Thank you. Looking at other products, you said you're going to offer life insurance. Are there any other products you're looking at, for example, ISAs?
The way that we are approaching additional product opportunities is by considering a three-step approach. Our first priority is to bring as many invested customers onto the PensionBee technology platform as we can, because that will enable as many people as possible to save for retirement, and it will, of course, enable us to grow our customer base. Our second priority is to help our customers to grow their pensions with PensionBee so they can have that happy retirement, which is the point that we were just discussing. And our third priority is to make sure that our customers have access to additional products that can be helpful in achieving that happy retirement. And so the way we think about life insurance, for example, is that once our customers are with us and once they are confident that they are saving enough for their future, they will need access to products to make sure that their plans for retirement don't get derailed. Our view is that the worst can and does happen. And in our research with our customers, we found that there is a strong appetite for life insurance, for protection against very unforeseen and challenging circumstances. And so we see the life insurance product as fitting really well under the umbrella of helping our customers to prepare for and ultimately to have a happy retirement. I'm sure there will be other product opportunities as well. Everything we do at PensionBee is led by our customers and what they tell us that they want and what they tell us they need. And so we will keep all product opportunities under review. But certainly we think that life insurance is a very good place to start, and one that we will be quite actively exploring very soon.
Well, on that point then, what will the revenue model be for the life insurance offering?
We are initially starting off with a very straightforward referral model. And as we establish product market fit, we will see if there is any need to go in any other direction.
Okay, thank you. Let's move on to marketing. Had a successful partnership with Brentford FC. How long is left to run on this? And is there a risk that it becomes more expensive now they've established themselves as a Premier League club?
Very good question, and perhaps I could take that question, but also the subsequent question, which is about how marketing spend is going to be more efficient given the brand awareness, because I think these are quite interlinked together. Mm-hmm. The way that we are viewing our marketing expenditure and our brand awareness and our customer acquisition is by looking at what has happened to date. And so far, we have spent about £45 million building a household brand name. That means that a majority of people recognize the name PensionBee, and therefore we've established a critical base of awareness. That gives us the opportunity to change the mix of our marketing channels somewhat. In the early days, before so many people had heard of PensionBee, it was really important to invest in certain kind of longer dwell time, kind of longer running brand advertisements. So channels such as primetime television or perhaps long dwell time outdoor advertising. Now that we've established that level of brand recognition, we can focus more on shifting some of the brand expenditure that we have into channels that have a lower cost per brand mention. And those channels can typically be channels such as radio, channels such as sports sponsorship, which the very first question noted is an important one for us. And of course, through these channels, what you can get is rapid and frequent repetition of the PensionBee brand name, of the PensionBee logo, and so we believe that they will remain a critical component of the marketing mix. We treat our sports sponsorship channel like we do all of our channels, ensuring that we obtain the appropriate return on the investment and ensuring that it fits into our long-term trajectory of bringing down our cost per invested customer.
Okay, well, that probably ties quite nicely then into achieving your adjusted EBITDA move into positive territory towards the end of the year. How will this be achieved? With the annual run rate of revenue at around 20 million and an adjusted EBITDA loss of 20 million in 21, how will you achieve this move? Is it through a cutback on marketing where you spent 17 million last year?
I'm happy to take this question. So I think the first point to note is on the profitability target that we have at the end of this year on an adjusted EBITDA basis. The reason why we focus on adjusted EBITDA is because it's also a proxy for cash flow. Another point to highlight is, given that we have achieved at the end of last year adjusted EBITDA profitability, that basically means that we are covering with our revenue all costs excluding the growth capital, and we have achieved this at the end of last year, and that means for the full year this year we will cover all our operational costs with our own revenue. So the marketing clarification that we gave to the market for 2023, thanks to our high brand awareness, which was a reduced marketing spend of to roughly 10 to 12 million pounds. And the reason why we did this is because of the increase in brand awareness, which allowed us to still have very high customer growth, but at much lower marketing spend. And that basically means that the expected acquisition costs on a unit basis, we expect to come down this year. And so that allows us then to achieve that profitability target at the end of this year. And then from going forward, we would then basically be self-funding that growth with our own cash flow generation. I hope that makes sense.
Thank you. Well, on your own cash flow generation, what is your level of confidence over your comment that no further funding will be required, given you burnt through more than 20 million in 2022?
Yes, that's a very good question. So I think we feel very confident that we don't need any further capital to fund up until the profitability point on beyond. And I would like to give you some data points that we have stated publicly to triangulate that statement mathematically. So when you look at the consensus forecast for 2023, that is roughly in the mid-20s, so around 25 million pounds. If you multiply that with the net revenue margin, which has been very resilient and reliable historically, of around 85%, that gets you to roughly 20 million pounds of net revenue. That would basically cover for this year all the operational costs. So then from a marketing perspective, I just mentioned that we would expect to spend around 10 to 12 million pounds in marketing. That basically means that the expected cash utilization for this year, so 2023, would be that marketing amount. So would be around the 10 to 12 million mark. So if you then tie this back to the last reported cash balance number at the end of 2021, which was 21 million pounds, you deduct the, let's say, 11 million of marketing capital requirement for this year, gets you to around a 10 million pound cash number at the end of 2023. And so because at the end of 2023, as we have achieved or as we expect to achieve the adjusted EBITDA profitability target, which also means the cash flow generative target, that at this point we become then self-funding. So when you visualize kind of that cash evolution on a quarterly basis, this year we're obviously still funding the marketing, so it will trail down. But as we are very firm on our commitment to profitability at the end of this year, which also corresponds to the cash flow generative ability thereafter, means that from that low point we would then start to generate cash. So to come back to the question, this kind of this kind of expected execution of the business plan gives us the comfort that we fund the business up until the profitability point, and from that point on, we become self-funding to fund future growth with our own cash flow generative revenue ability.
Okay, let's move on to the point of how much cash you will generate. We've got a couple of questions here which sort of converge around the same point of margins. And obviously, you've got the long-term revenue opportunity that you talk of 150 million. How realistic is your margin assumptions to hold over the long term? It's one comment here, charge customers over 60 basis points, and somebody else talks about 50, but it's more expensive than other platforms offering a similar service. So do you think margins will hold up over the longer term?
Yeah, I think one of the really important points to understand about our revenue margin and essentially the pound-based charges that our customers pay is that we have an all-in fee, which includes the underlying fund fees as well, which is quite a distinguishing factor between us and others in the market. And if you do a comparison of how much our customers pay on a pound basis, given a relative pension pot versus how much they pay on a pound basis for the same size of pension pot across other platforms, individuals who have done that analysis have found us to be actually one of the most price competitive options available, regardless of whether you're looking at a £20,000 pension or a £150,000 pension. So we are confident that we are actually very price competitive when you look at the pound fees that our customers pay relative to what they would pay elsewhere. And as a result of that, we maintain an exceptionally high retention rate as well. Our retention rate is, of course, over 97%. But pricing in general is something that we, of course, think about quite carefully. And the way to think about pricing within pensions is to focus on three elements. The first is performance, the second is costs, and of course, the third is service. And those are kind of universally considered to be the primary drivers of value for money, as it's called within the pension space. And certainly because we use index-based funds, our performance tends to be very much in line with general market performance. Our costs, as I mentioned, are on the lower end when comparing on a pound for pound basis versus what our customers would pay elsewhere. However, our service levels and the quality of experience that we offer to our customers is exceptionally high, whether you look at that from the digital interface and technology offering that we have to the individual features that enable our customers to combine and contribute and ultimately to withdraw in an easy way from their pensions, all the way up to our customer service, where we take great pride in picking up the phone in just a couple of seconds or answering live chat as soon as somebody comes online. And so, we believe that we offer excellent value for money for our customers, but are also very happy that we are very much kind of at the lower end of the cost spectrum compared to what someone would pay on a pound for pound basis anywhere else. And so with that in mind, we feel that the pricing will remain appropriate so as to deliver value for money for our customers, and that's really what will drive any pricing decisions that are made.
Leading us neatly onto the competitive landscape then, could you give us a little bit more detail? Your peers look to be waking up to your presence. AJ Bell has launched a pension finding tool. Has this had any impact? And what about other new entrants into the market?
Well, our overall view is that the market is incredibly large. There's around £1 trillion of defined contribution pension assets, and about 70% of those are sitting as preserved or dormant or just, not receiving active employer contributions. So it's an incredibly big market. We believe that our value proposition is really quite unique for the reasons that I've, just outlined, and therefore we haven't seen much of an impact from the competition. competition. What we do see is research such as that developed by Equity Developments, sort of comparing the absolute growth in customers that we have, and also the absolute growth in net flows that we've had versus other peers in the market. And we would encourage everyone to read that to get a sense of kind of the competitive dynamic.
Thank you. Question here on how you move customers through the pipeline, driving them, converting them from registered customers to invested customers. How do you achieve it, and what would these customers do otherwise?
Yeah, so the registered customer base are individuals who have generally started the process of asking for a pension transfer, or the process just before making a contribution. However, they haven't yet completed it, and their account is not yet funded. So the main drivers that cause individual to wait are really to do with inertia, and the fact that pensions can seem a little bit boring, a little bit complicated, certainly not to us, but to many others. And so our strategy there is to ensure that our customers are, our potential customers are receiving the right level of content and engagement from us. We have a lot of data that indicates that once customers get access to our tools and to our content, they are more likely to start feeling confident and empowered to do what they need to do with their pensions. And so we will continue to produce helpful content and helpful tools to enable those customers to be converted. Many of them will also receive email nudges or push notification nudges if they've started on the app. And so over a number of kind of weeks, months, and frankly, sometimes years, we expect those registered customers to continue to join PensionBee as the time becomes right for them.
Okay, thank you. Technical one here. How much have you invested in the platform to date, and what's the ongoing yearly spend?
I'm happy to take this one. So the technology platform for us is really the core aspect that helps to drive operating leverage. I think for this year, specifically in 2022, we have spent close to 18 million pounds in that platform that includes basically people costs, but also the all other aspects that are relating to the tech stack, so to speak. And the platform is post IPO and up until end of last year fully funded, so we don't expect any huge significant increases over this year or next subsequent years. I think we invested out of the close to 100 million pounds we did raise in combination of private raises and as well as the public raise. We invested circa half of that, roughly 50 to 60 million pounds into the technology platform, and therefore we feel quite confident that we are now in a very strong position to drive that operating leverage, drive customer acquisition onto the platform, and really generate over time that operating leverage that sees us then in the medium to long term to achieve that profitability targets on an adjusted EBITDA margin of greater than 50%, thanks to the scalability of that fully invested platform.
I suspect this next question we can sort of direct our listeners to the equity development research, because obviously we have put forecasts into the market. I don't know if there's anything you want to add, but with total revenues of 17.7 in 22, that were only 8.5% higher than the stated run rate back in December 21, despite the huge growth in customer numbers. What are your expectations for the 2023 revenue, given your stated annual run rate at the end of December of 19.5 million?
Yeah, I'm happy to take this one. I think maybe just first a clarification on 2022 and there I think the way of how we're thinking about it generally as we drive growth and customer acquisition going forward, there are kind of two components how this translates into AOA growth. One is kind of inside our control and one is kind of outside our control. The one that's inside our control is obviously the effective deployment of capital, onboarding of customers, and then ensuring that the product allows for additional contribution and consolidation. So that is those are all aspects that are inside our control. However, there's a part of the of that that's also outside our control, which is capital markets. And as it is customary in the industry, pension assets are invested in capital markets and therefore are impacted to some degree from market volatility. So I think when we're looking at 2022 and are thinking back on the backdrop over the year, it saw a lot of unique kind of situations in some degree in terms of geopolitical tensions, high inflation, very decisive central bank actions to deal with that inflation, and that translated then into that market volatility. So if you take those two together in those aspects that are inside our control and that are not inside our control, there was a big component in 2022 that was driven by markets, and therefore that has then translated into the asset base and therefore revenue, which is why the revenue came out at around 18 million pounds. I think how that would translate then into how we're thinking about long-term guidance and where we get long-term is that we calibrated that understanding of aspects that are inside our control and aspects that are outside our control into our guidance framework, which we included in the presentation. And therefore, I think what's really important to understand there is that is really the underlying opportunity from a market perspective, given the sheer size of the market, but also the structural growth driver around auto enrollment, and then us as PensionBee being quite well placed to cater to that mass market that is really benefiting from that auto enrollment structural growth driver. And so therefore, I think the guidance that we're thinking about in the long run is the one that we would highlight, and the 150 million pounds that we target in the medium to long term. The reason why we added a bit of a range, so from 5 to 10 years, is because the parts that is outside our control would then translate into a timing component in terms of if the market are particularly strong, we may get there a little bit sooner within that window, and if the market is not as supportive, then maybe a bit at the later end. But I think structurally, given that the market by itself is huge and is growing, and we are quite well placed and focused specifically on that growth piece in the pension market, I think we are quite well placed in the long run to capture. And just to tie it back to the initial question, that's why we're also looking at it from a long-term perspective rather than what's the very specific guidance on a specific £1 million deviation number for the particular year in 2023 might be less relevant, and therefore we're focusing a bit on the longer horizon, if that makes sense.
Thank you. And I think, listen, the pensions have been front and center this week. I'm assuming that the allowance changes will have little impact on the business given the average pot size, but if you could confirm that.
Yes, so for those who haven't been monitoring the pension changes in exceptionally close detail, I think the three kind of major highlights are that the standard annual allowance will increase from £40,000 to £60,000. The money purchase annual allowance, which applies when you've taken income, will increase from £4,000 to £10,000, and the lifetime allowance will be entirely eliminated. We have, however, in the subsequent days, heard that a different approach would be taken by Labour if they were to come into power, and the lifetime allowance may well be back. And so I think with all of these tax changes, we tend to focus on the kind of the bigger picture, the longer term. I think anything that makes pensions simpler is good. And so the elimination of an allowance is, of course, going to make pensions simpler. However, I would say that on the margin, most people don't come anywhere close to the lifetime allowance or anywhere close to contributing £40,000 in their pension in a given year. And so the impact will be a positive one, but probably a marginally positive one.
Okay, thank you. Well, I think that is it for today. So that just leaves me to say thank you to you both. And we look forward to an update in 6 months' time when we will be even closer to that adjusted EBITDA positive breakthrough. Thank you to you
very
both.
much. Thanks for having us.
Thank you very much.